Hello, thank you for joining us for this webinar on demystifying employee share schemes for your client. Whether you're joining us live or whether you are watching this on the recorded version from our website, really good to have you with us. So we're going to start today by looking at why we might need to use an employee share scheme, what the benefits of it are, and then we're going to go through in a little bit more detail some of the schemes that are available to us and to our clients. So let's start with what the problem is. Companies can give actual shares to employees. From a corporate law point of view, that's quite straightforward. But from a tax perspective, it gives us a problem, because if somebody receives shares in a company because of their employment, they are going to be taxed on any discount they receive unless they pay full market value for them. And depending on the circumstances, there might be a national insurance contributions charge for both the employee and the employer as well. So if shares are given, it actually might not be an incentive for the employee working hard, because they're going to get some shares, but they're not going to get any cash with which to pay the tax with which to cover the tax. So the company might then decide to loan or to give them the money to pay the tax, but there's a cost to the company there, obviously, as well. So actually giving shares is not always that much of an incentive. And then from the company's perspective, if employees leave when they already have actual shares in the company will usually want to get them back, because very few companies want people to leave and be building up value in the company without actually still working there. It doesn't seem fair. So you can end up in a position where the company has got to pay the employees for the shares, and also go through a whole corporate law process of actually getting the shares back. So those are some of the problems that are created with giving actual shares to employees. So in terms of a solution, we have various share option schemes, and a share option is effectively just the right to buy shares at an agreed point in the future for an agreed price. And there are 4 tax advantage share schemes offered by HMRC. These used to be called approved, but they're now called tax advantage share schemes. There are 2 that are most suitable for SMEs, so we're going to focus on those. And there are 2 that are usually used by larger companies. So we'll talk about them briefly for completeness, but we won't focus on those ones. So the first share option scheme, and the one that we most commonly advise clients to adopt, is called an EMI, or Enterprise Management Incentive. So this is a share option scheme. The employee doesn't get actual shares on day one. They get a share option, which, as we've already said, is a right to buy shares in the future for an agreed price. There's no tax on the grant of the option. And there's no risk to the employee, because they will have an agreed exercise price. But if it comes to the point of exercise and the shares aren't worth that amount, they can just choose not to exercise. So there's no risk to the employee. Any increase in value after acquisition of the shares will be subject to capital gains tax and not income tax when they're eventually sold. And business asset disposal relief, which, as some of you may know, is a relief which gives a preferential rate of capital gains tax to people disposing of shares and other assets. That will be available if all the other conditions are met. And when shares are acquired through EMI, the usual 5% shareholding requirement doesn't apply. So if you've got an employee, and this is quite common, where they're only being given, say, 1% of the company, ordinarily, if that wasn't within the EMI wrapper, they would not be entitled to business asset disposal relief. But if the shares are acquired through EMI, they will be entitled to BAD relief, assuming the other conditions are met. So in terms of criteria for the company, and really if a company meets this criteria, or the set of criteria, we would usually say that EMI is going to be the gold standard, or the best solution for them. So if they do meet the criteria, EMI is probably going to be the one to go for. So the company can't be controlled by another company. So you can't have an EMI scheme over shares in a subsidiary. It has to be in the top company. And this happens quite often. Even if employees are employed by a subsidiary, they can get EMI options over shares in the top company. And that's very commonly done. Any subsidiaries must be at least 50% owned, or 90% for property management subsidiaries. The gross assets of the company or the group, if it is a group, needs to be below £30 million. There needs to be fewer than 250 employees in either the company or the group. The options must be over fully paid up non-redeemable shares, There has to be a UK permanent establishment of either the company or the group, and the trade of the company can't be on HMRC's excluded trades list. The excluded trades are usually mainly around sort of property asset-backed businesses, hotels, nursing homes, things like that. They're most, not all, but most of the excluded ones are property and asset-backed businesses. In terms of criteria for individuals, they have to be employed by the company or a group company. So we had one recently where the individual was employed by a company that was outside the group, so we couldn't use EMI. They have to be employed by a group company. They have to meet the working time requirement, so they have to work for the company for at least 25 hours a week, or if they're part-time or work less than that, it has to be at least 75% of their working time. And they can't have a material interest in the company, which means that they can't have more than 30% of the share capital of the company at the point at which they acquire the EMI shares. The excluded trades we talked about already, as you can see, dealing in land, goods, banking, insurance, lots relating to property development, asset-backed businesses, hotels, and so on. So advance assurance can be obtained. So this is something we commonly do. We would write to HMRC and we would set out essentially how the company meets those criteria. We would explain what it does, how many employees it has, what its gross assets are, and so on. And HMRC will then write back and say, yes, we're happy this company qualifies to issue shares under EMI. Not always necessary to do it. We usually do because it can run alongside the valuation. But it's particularly helpful if you've got a client whose trade is sort of similar to something on the excluded trades list, but we think it's not actually excluded. It can be helpful to get HMRC's confirmation that they're happy with that too. The valuation can be agreed in advance, and that lasts for 90 days. And then the scheme and the options must be registered by the 6th of July following the end of the tax year of issue. So at the moment, obviously, we are in the 25-26 tax year. So any EMI options must be notified by the 6th of July 2026. So the way it works, when we get the valuation, we say to HMRC, right, we think the shares are worth, and obviously I'm going to make up some easy numbers now. We think the shares are worth £1 each now. And we will explain, we will do a valuation report saying why we think that the £1 per share is the current value of the shares. And then, assuming they agree, the options are granted. And then when it comes to the point of exercise, which might be linked to an exit of the company, it might be after a period of time, or it might be when performance criteria are met, the employee can exercise their options, they can get their shares, but they won't be taxed on any discount they've received because we've got the EMI wrapper. So let's say by the time they exercise, the shares are worth £5 per share. The employee is only going to pay £1 for them because that's what was agreed with HMRC. But whereas, as we said at the beginning, normally if you give employees shares, they're taxed on any discount. Because we've done this through EMI, employees can pay £1, get a share worth £5, and they won't be taxed on that discount. That's the difference under EMI. And then, as we've said, when they come to sell the shares, they can benefit from business asset disposal relief, a preferential rate of capital gains tax, even if they don't have the usual requisite 5% of the company. So those are the two key benefits of EMI. So as you can see, it's a really, really good scheme, very beneficial. And really, if a company and its employees fit within the criteria, that probably is the one to go for. So it's by far and away the most likely answer to the question of which share scheme. It's not always the answer. So the most common reason we wouldn't be able to use EMI is because the company has a trade that's on the excluded trades list. That's the usual reason we can't do EMI. So the next thing that we would look at in this scenario is a company share option plan, or CSOP. And this works in exactly the same way. So an employee will get an option, a value will be agreed with HMRC in advance, and then when the option, when the share options vest, means it becomes available to exercise and to get actual shares, the employee only pays the agreed price, and they're not taxed on any discount they receive at the point at which they get the actual shares. So it has some benefits and some drawbacks compared to EMI. So as I've already said, the advantage is there are no excluded trades. So if you've got, a hotel or a property business or something like that, CSOP would be suitable, but EMI wouldn't. So that's a key advantage. However, the individual limit is £60,000 worth of options rather than EMI, it's £250,000. So you can see, depending on the value wanting to be awarded, a bit more restrictive. And options must be exercised after 3, but before 10 years. So there's more of a restriction in terms of when options can actually be exercised. So if someone wanted to exercise before 3 years, then a CSOP would not be suitable. It's not really often a problem because usually companies are doing these schemes because they want to tie people in to stay for 3, 4, 5 years. So usually it is a longer term plan, but occasionally it can be a problem, so it's important to be aware of. And as we've said, with EMI, no tax on the grant of an option, no tax on exercise, provided the exercise price isn't lower than the market value of the date of the grant, that £1 per share we talked about. Along with EMI, increase in value is subject to capital gains tax and not income tax. And at the end, business asset disposal relief may be available if the other criteria are met, but in this case, you do need the 5% shareholding. So you don't have that relaxation as per EMI. So you can immediately see why we would say that EMI is the gold standard and the one to go for if the company and the individuals qualify. So in terms of criteria, it's pretty relaxed for a CSOP, actually. It can't be an unlisted subsidiary. That is the only real criteria. So if you've got your usual sort of trading company with a holding company, you can't have the options over shares in a subsidiary. It would have to be in the top company. So essentially it would have to be a single company or a group with the options over shares in the top company, listed on a stock exchange. It has to be a company that's not under the control of any other company. So just no unlisted subsidiaries essentially is the takeaway from that point of view. In terms of individual criteria, there must be an employee, and for employees there is no working time requirement as distinct from EMI, or a full-time director, and that's defined as more than 25 hours a week. And they can't have a material interest. So as we said for EMI, they can't have more than 30% of the shares in the company. So this is not intended for founders or anything like that. This is a sole founder. This is intended for incentivizing employees who are going to have a stake in the company, but not going to be controlling the company. In terms of the admin, it has to be certified to HMRC. There's a self-certification process for CSOP where you have to go through and actually confirm to HMRC that the criteria are met at every stage. So those are the two that we would normally use, the EMI and the CSOP, and you can see immediately some differences between the two. So share incentive plans. The difference with these compared to EMI and CSOP, EMI and CSOP, as well as all the advantages we've already talked about, the company can select which employees can take part in the plan. So for SMEs, they don't usually want to offer absolutely everybody share options. And with EMI and CSOP, they can select who goes into the scheme. With the next two we're going to talk about, share incentive plans and then save as you earn, the company has to offer it to everybody. So this tends to be, your really big companies that have a share plan for everyone, even people who are very junior, very part-time. That's sort of the aim of these, not generally suitable for SMEs, but for completeness, we will talk through them. We've talked about the fact that it has to be made available to all employees. A pre-qualifying period can be specified, so something like a probation period or something like that. And you can differentiate the terms based on certain factors, but it has to be on the same basis for everybody. The shares have to be listed on a recognised stock exchange, in a company that's not under the control of another company, or in a company under the control of a listed company. So again, you can see no unlisted subsidiaries essentially. And with a SIP, you do need to use a trust is required. So it's kind of quite complicated, quite expensive to administer. it's not generally something that small companies want to do, just because the cost of it and the complexity of it is disproportionate to the value that they are going to get from it. But how does it work? So essentially, a company under a SIP can award employees a certain number of shares per year. So they can give people up to £3,600 worth of free shares each year. So you can see already you're going to need a valuation. So again, that's another expense that's needed every year. Whereas with your EMI and your CSOP scheme, you would do the valuation at the beginning and only need to do it, if somebody new happens to join, you're going to need to do this every year to work out how many shares you can actually give to people to make up £3,600 worth each year. But then on top of that, the employees can purchase up to £1,800 worth of partnership shares from their gross salary. So again, the valuation obviously comes in there because you need to know how many shares people are actually allowed to purchase. Then we have matching shares, where the employees do choose to invest in those partnership shares. Employers can give them 2 shares for every one purchased, and again, up to the maximum value of £3,600 per year. And then finally, dividend shares. Employers can elect that rather than receiving any dividends on the shares that they obtain, the dividends are reinvested in new shares, and there's no limit on that each year. So as you can see, there's four different ways really of employees getting shares through a SIP. And then the final tax advantage scheme that I wanted to talk about is known as Save As You Earn. So this is commonly used again by large companies because you have to offer it to everybody. So this is essentially a savings plan. Employees can enter into a plan over 3 or 5 years to save an amount of money from their salary each month. Between £500 and £500 per month can be deducted from their salary and put into the savings scheme. You can have a tax-free bonus at the end of the period, and a scheme is linked to share options, and the company can offer up to a 20% discount on market value at the date of grant. So there's a tax advantage there because, as I said right at the beginning, normally if people get shares because of their employment, they get a discount, they get taxed on it. In this case, the money is used to buy shares, and they can have a discount, but they don't get taxed on the discount received. And there's no tax or national insurance contributions on any discount on exercise. Again, shares must be either listed on a recognised stock exchange, in a company that's not under the control of another company, unless that's a listed company, or in a company which is controlled by an employee ownership trust. So I'm not going to go into too much detail on SIPs, Save As You Earn, because we very rarely see them in our SME clients because of the fact you have to offer them to everybody, and the complexity and expense of setting them up, administering them, and having to do valuations multiple times. So we quite often get asked about growth shares. So I just wanted to talk about that while we are on this subject. Quite often, founder shareholders want to retain the value that they've built up so far. You can understand why. They say they've made sacrifices, they've not had holidays, they've missed time with their family and so on to build up a business. So they don't want to then offer shares to other individuals, and those other individuals benefit from the value that was built up before they were involved. So what we can do in this case is a special class of shares can be created, and the rights on the sale of a company can be set above a hurdle level. So employees can share in the value from the point at which they join the company onwards. So by way of example, let's say that a company is worth £1 million when somebody joins in a senior role, and a founder says, I want you to have some growth shares. And what we're going to say is that when the company is sold, the first £1 million is reserved for me as the founder, but then you get your proportionate share of any value above £1 million. So the person is benefiting from the value going forward from the point that they joined. Often the shares will have no voting or dividend rights. They're just benefiting on a sale. They're usually subject to good and bad leaver provisions. So usually if someone's a bad leaver, so they have resigned to go to a competitor, or they've been dismissed, there's been a gross misconduct situation, usually the shares will be bought back at the lower of market value and price paid. Whereas if someone's a good leaver, so let's say they have become disabled and can't work, or you had to make them redundant, often the shares will be bought back at the higher of market value and price paid. That can be varied, but that's the norm. And the idea is that the value is extremely low due to all those restrictions on the rights, because essentially they've only got the hope value, haven't they? If somebody comes in when a company's worth £1 million and gets some shares that only have any rights when the company is sold for more than £1 million, really it's just that hope value, isn't it, going forward? HMRC have started to look more at this in recent years. People used to try to argue that the shares were worth nothing because of that hurdle. HMRC are not happy with this these days, because they say, and you can understand the argument, they say that, why would somebody accept this as part of their remuneration package? Why would it be an incentive to somebody if they genuinely think there's no value? The value obviously is the hope value. So we do have to do a valuation exercise, and we would look at various factors to arrive at a value, including how much higher the hurdle is than the current value, but lots of factors that we would look at. One of the downsides of growth shares is, unless you do a growth share combined with an EMI scheme, then there's no mechanism to agree that value in advance with HMRC. So there is a risk that somebody pays, £1 per share, and HMRC then challenge that and say, well, we think these shares are worth, £5 per share when you got them. We want the tax on the discount. So it's important to get a professional valuation to back up why the shares were treated as not being worth very much when they were acquired. So having talked about all of those things, we're now going to talk about what happens if we don't use a tax advantaged share option scheme. So these used to be called unapproved option schemes. People still sometimes call them that. And essentially, they are very flexible. That's the good thing about them. There's no limits or restrictions. No restrictions on trade, no restrictions on the amount of the value that people can receive, so on and so forth. But the disadvantage is, as the name suggests, there aren't any tax advantages. So this would work as an option in the same way as we've talked about before. So someone might say to their employees, right, these shares are worth £1 each now. And you stay for 3 years, and you can then exercise these options. You can get the shares, and you only have to pay £1 each. So everything's signed by the company, signed by the individual, and then everything proceeds as planned. And after the 3 years, the individual says, I'd like to exercise those options and get the shares. I'm going to pay the £1. But by then, if they're worth £5, they will be taxed on that £4 per share discount they receive. So there aren't any tax advantages, and there might be national insurance contributions if those shares are readily convertible assets. And there is a long list of ways that it can be an RCA, or readily convertible asset. But the main one is if there are trading arrangements in place. So if there's a sale on the cards when somebody gets their shares, then there will be RCAs. And also if it's an unlisted subsidiary, then there will be RCAs. So that would mean that employers and employees' national insurance contributions are also due. So you can see these work well if the criteria for the other schemes are not met. These are often used for either overseas employees, for whom obviously the benefits of EMI wouldn't be relevant because they don't have a UK tax liability, or for consultants and contractors who don't qualify for the employee schemes. And what we often have is an EMI agreement for the employees, and then a parallel agreement for contractors, which is identical in terms of how it works, but has all the EMI wording all stripped out, and that's quite common to have that scenario. So you can do non-tax advantaged or unapproved options, and the summary is that the benefit is very, very flexible. The drawback is that they don't really have any tax advantages. So in terms of reporting for all of these share schemes, so the regime under which HMRC keeps track of which employees are getting shares because of their employment and make sure that the appropriate amount of tax is being paid is the Employment Related Securities or ERS portal. So there is a section of HMRC's sort of website all about ERS where returns have to be filed. So there are two things that need to be done. As we said earlier, a report has to be made by the 6th of July following the end of the tax year. And that is for things like EMI and CSOP. It is also for non-tax advantaged options and just awards of shares. So if your client says to an employee, we're going to just give you some shares, it's not EMI, it's not CSOP, we're just going to give you some shares, that still has to be reported. And people often miss that, and then there are penalties going back several years. Once it's been reported, there's then an annual return required every year. So if it's an ongoing scheme like an EMI scheme, every year by the 6th of July, the company will need to go on and file an annual return. And we do that for lots of clients. We start on the 6th of April when the tax year has finished, and it goes through to the 6th of July when the deadline is. Where as I just said, even if you've got a one-off award of shares, you still need to make that report to HMRC. If you don't then go in and close the scheme, you will still have to do an annual return every year. So the EMI scheme obviously has to stay open because it's ongoing. People's options are outstanding until they actually get the shares. With a one-off award of shares, if your company is giving somebody some shares and that's it, nothing else is going to happen, it's worth then going back on, closing the scheme after you've reported. Otherwise, you will have to do annual returns every year, even though nothing's going to happen again with that scheme. I want to talk briefly about Section 431 elections. So there's often a lot of confusion about these. And the premise behind it is that most shares in private companies have restrictions attached to them. So usually, as I said earlier, for example, it will say, the articles or the shareholders agreement will say that if somebody leaves, they have to sell the shares back. It will usually say that they can't transfer them to other people, and so on and so forth. There might be various other restrictions. So for that reason, each share has two values. It has the actual market value, known as the AMV, and it has the unrestricted market value, known as the UMV. And it's possible to actually elect to disapply this treatment. And the benefit of it is that if you don't, then an element of any growth in shares, share value, might be subject to income tax on sale rather than capital gains tax. The reason when we do EMI schemes, we don't have to talk about this, is that with EMI there is a deemed Section 431 election. So that is good news. That's why if you've worked on an EMI scheme with us, we probably haven't had to talk about this. But with other share awards, we do. And the problem is, for example, that if an employee pays the actual market value when he or she acquires the shares, and that's £1, but the unrestricted value is £1.50, there wouldn't be an immediate tax charge on acquisition because they've paid the actual market value of £1. But on subsequent disposal, a third of that growth in value, because obviously the difference between the £1 and the £1.50 is the 50p, the third of the value. If you don't have a 431 election, a third of the growth in value will be subject to income tax rather than capital gains tax on a sale. And obviously, we've got an example here, which I'll run through in a second, where the numbers are fairly small for example purposes, but you can imagine that in a genuine situation, this is actually, potentially huge. So I always think this is best explained with an example. So in this example here, you can see an individual's acquired 10,000 shares, and the AMV, the actual market value, is 90p, which they paid. So there's no income tax on acquisition because they've paid the market value. But the unrestricted market value was £1. And then further down the line, those shares are sold for £5. So firstly, let's go through the scenario if we don't have an election. So the acquisition cost is £9,000. That's been paid. Subject to income tax on acquisition, nothing, because the AMV has been paid. Then further down the line, we have sales proceeds of £50,000. £5,000 is subject to income tax on sale. £36,000 is subject to capital gains tax. So we end up with an overall tax bill of £7,290. Whereas if we signed a Section 431 election, again, acquisition cost £9,000, that's the same. The effect of the election is that they elect to be taxed on the difference between the actual market value and the unrestricted market value at the point of acquisition. So you can see here, they're going to be subject to tax on £1,000 because obviously that's the difference between the 90p per share and the £1 per share. So they're going to have some tax to pay on acquisition. But then when the shares are sold for £50,000, there's no income tax on sale because that election was signed earlier on. There's a larger gain subject to capital gains tax, and the overall tax ends up as £6,050. So you can see the effect of the election is to make the overall tax on sales lower. So in the vast majority of cases, it will be worthwhile signing an election. The only time it wouldn't have been worthwhile is if the value of the shares goes down, because there is no way of reclaiming this tax that the individual paid on acquisition. So that has to be pointed out to people. But in the vast majority of cases, when everything proceeds as planned, there's a company sale, it will have been worth their while signing a Section 431 election. It's a slightly strange system because the tax advisors like us will prepare the elections. They have to be signed within 14 days of the shares being issued. But there is then no filing of them. They just are put carefully in a file or desk drawer until they're needed at the point of sale. And there have been cases where HMRC have essentially not believed that the election was signed and that it's been fabricated later. So it's always worth emailing them around between all parties so you can show that that election was definitely signed within 14 days in order for it to be valid. Finally, just a couple of overseas considerations. People often assume that if an individual's overseas and there's no issue from a tax point of view with share options, there can be a tax charge on a UK resident who subsequently becomes non-UK resident because of the element of time when they were in the UK. And the other way around as well, non-UK residents may incur a UK, apologies for the typo, UK tax charge if they spend time working in the UK. So it can go both ways. So double tax treaties must be reviewed to work out what it says in the tax treaty between the UK and the specific country. As you can imagine, that's highly complex and also very bespoke to the individual circumstances and the country. So not going to say anything more about that now, but it's just to have at the back of your mind that just because somebody's not in the UK doesn't mean there's no UK tax charge. So that's all I had to say in terms of share schemes. That's our half an hour. Very happy to take questions if anybody has any. Otherwise, our next session is in a couple of weeks, Wednesday, the 17th of September, which is going to be around using holding companies and group structures. So we're quite often asked to advise on this. People want to put a holding company in, and there are very many benefits to that, which we'll talk about on the session. But there can also be some drawbacks. And actually, we've talked today, haven't we, about the fact that you can't have certain types of share schemes in unlisted subsidiaries. So you do have to consider those types of things as well, rather than just putting in a holding company and assuming that it's all going to be good news. So hopefully you'll be able to join us for that. The link will be in our newsletter, and I will put it on LinkedIn as well. Or if you'd like it directly, just drop me an email, and we will send that through to you. So unless anybody has any questions, we will leave it there for today. But thank you so much for joining us again, whether you're live or whether you're on the recording, and we will look forward to seeing you next time. We don't have any questions, so I'll sign off now, and we'll see you later in September. Thank you.